Okay, so hi everybody. Thank you for joining us, our Secure Planning Group third quarter webinar. We host these the third Tuesday of each quarter. So we felt it would be a good idea to get everyone thinking about the end of the year and taxes and how to structure your end of year planning and keeping in mind how you're going to work with your tax professionals. So what better way to bring in to think about this than to bring in a true tax professional, Richard Feldman. Rich would like to make an introduction of yourself.
Hi, Neil. Thanks for having me. My name is Rich Feldman. I have an accounting firm in Ambler, Pennsylvania, Stein, Feldman, and Sampson. We're a five-man operation, and we specialize in closely held businesses, individual taxes, and varying from all different types of industries: real estate, hotels, restaurants, lawyers, medical practices, you name it, we do it. We kind of think that we're the quarterback for the businesses as well as the individuals, and hopefully they call us before they make any decisions, and we work side by side with them. And that's been our goal for the last 30 years.
Awesome. So thank you. And for everyone who's joining us today, we appreciate it. So, again, we won't allow anyone to ask questions, but just keep in mind that we're a Secure Planning Group. We did 13 different advisors that are here to work with you. Please reach out to them afterwards if you have additional questions. We're this time of year, we do get busy with these type of questions. So yeah, by all means, hopefully this brings out some good information for you. And then by all means, you'll just reach out to your advisors. So Rich, how about our goal today is to just go through some of the questions that may come up towards the end of the year. And we broke it up into two different parts. The first part, which is tax planning, and this is more for our family planning, or when we work with our clients. And then the second part, the financial health, is working with our businesses. So as we can see here, we're looking at the tax planning for families and retirement contributions, tax credits, tax loss harvesting, health savings account, charitable donations. And I'll go one more slide here. Perhaps we could just talk about some of these aspects, whether we just want to go one by one. How about let's just talk about contributions into retirement accounts. When clients come to you, Rich, how do you discuss this with clients?
Well, the first thing we know is if they're working at a company and they're just an employee, they either have a 401k if it's offered, or a 403b, which is the same type of retirement plan, but it's for a not-for-profit or a governmental, a school type of profession. So if they're teachers. So, we always look to see what they could max out into their plan. In 2024, an employee could put $23,000 away. If you're over 50, you get a catch-up provision of another $7,500, which is a good chunk of change to be able to put away each year. And as you know, Neil, it compounds pretty quick. So we always tell people, pay yourself first. It helps you to not live above your means, and you're putting money away that's growing tax-free. There's other Roth IRAs and regular IRAs. There's income limitations for those. So you just need to talk to your tax advisor about those individual types of plans. If you're self-employed, there's a self-employed plan, a SEP it's called, and those offer a lot of benefits. In 2023, depending on what you make, you could put close to $69,000 away. But it's again, it's a good way to cut taxes. We always say if you're able to put $69,000 away, the government is paying for 35 to 37% of that. So that's a good plan to start putting some money away.
Do you find when your clients come in that most people do max out or some other kind of level?
Well, most of the 401k people, they try to max out because they're also getting a match usually from their employer, which is always a benefit. It's found money. So even if the market goes down that year or isn't doing as well, they're putting money away at least to max out the matching of the employer. That's the first thing you want to look at any plan. And these plans are flexible. So, if times are a little difficult and you need some money, then you lower your expectations and you reduce your savings and your pre-tax contributions
Mhm.
deferrals. Um, Try to max out. It's always a good way to put money away that you're not going to touch.
Awesome advice. We say the same thing. So coming from two professionals. So how about the tax credits? How about talking about tax credits as opposed and also bring in the idea of standard deductions?
Yep.
What's the difference?
Okay. So a standard deduction that's what everybody calls the old itemized deductions. So with standard deductions, there's different levels: single, married filing, separate, 14,600. That you get right away. Even if you don't own a home, you don't have real estate taxes, you don't charity, you're going to get that. Married filing joint, 29,200. It's a guaranteed deduction. They get raised each year by the inflationary deduction. And again, this goes hand in hand with charity. Just because you make a charitable deduction doesn't mean it's going to help you save taxes if you're below the standard deduction. And we can get into that when we talk about charity. Standard deduction is totally different than a tax credit. Tax credits are tuition credits, the American Opportunity Credit. Again, income levels can reduce this and make it not beneficial to you. So that's one thing to look at. A lot of people these days have been buying, electric cars and getting tax credits for those. But you got to be careful because those tax credits, they run out. Just because you go buy a Tesla doesn't mean you're going to get a tax credit, depending on the model. A lot of people go to me, oh, I just bought an Audi. They said I can get a tax credit. Then you go on the IRS website, it's not available anymore. So you just got to watch yourself. A lot of people fixing up their houses these days because they're not moving, but they want to put money into their home. There are many energy efficient home improvement credits, solar energy credits. Again, you got to be careful. Everyone is different. And some of them can create a refund, some of them can't. So depending on your tax liability and your income level, depends on how much that you can use these things.
Okay, so when you get a credit, so standard deduction is what, a deduction off of
Deduction.
your
Yes.
gross income.
Credit is dollar for dollar against your tax. So some of the energy credits, $600. If your tax liability was $5,000, it's down to $4,400. A
Okay.
standard deduction is a deduction and it saves you whatever tax bracket you're in.
Mhm.
It's not dollar for dollar.
So other than these that are listed here, education, energy, childcare, is there any other tax credits that are out there?
Well, when you go to energy, that's there. When you go to energy credits, there's 50 different types of energy credits. So that's a long, long laundry list that you can look into. I mean, there's your water heaters, your solar, your windows, your doors, your heating system. There's so many different ones. Um, when it comes to college tuition credits, most people it's this American Opportunity Credit. it's maxed out at $2,500. But again, if your income level is above a certain amount, you don't get it.
Say,
So there's, that's and then the child tax credit, again, child tax credit, it's up to, I think it's $2,000 for the child tax credit this year until they reach age 17, and then it's gone.
okay.
You do not
So,
get in the old days a deduction for having a dependent. That's gone.
okay. Let's move on to tax loss harvesting because this is a big one. We, as advisors, this comes up a lot on an annual basis with our clients. Of course, it comes up more when the markets are in a down period as opposed to what they've done over the last few years. But perhaps you can give us some insight about that.
Well, so this is the time of the year, as Neil, you just stated, that every stockbroker, investment advisor is calling us and saying, I got some losses. Should I take them? And I say, well, if you still like the stock and you want to take the loss, take it against gains. And obviously you wait 30 days and you can buy it back if you really like it. One of the issues, I don't know who's on this seminar, is if you're in Pennsylvania, and in most states, you don't want to take a ton of losses above and beyond zero to get you to a negative capital loss for the year, because in Pennsylvania, you can't carry losses forward. So that's very important that when you talk to your advisor, that you try to get to a break even when it comes to capital gains and capital losses. So that's very important in Pennsylvania, and most states do not allow you to take capital losses and carry them forward like the IRS does for federal.
That's just for Pennsylvania but the federal return, I mean,
Federal return, you get to carry them forward forever. You only can go negative $3,000 when you net out everything for the year. But yes, we always take, we try to get everybody to a break even, because
Mhm.
if you have a negative $100,000 in capital losses, you're only able to use $3,000 against other income. So why lose the 97,000 that you get to carry forward for the state, for the IRS, where you can't carry forward for the for the state?
Okay. So, so how about, and we do, and so 2 years ago, the market was on a downward spiral. So throughout the year, we were doing our tax loss harvests, but usually we do end up, for most years, it's just towards the end of the year. Is there any advantageous to doing it throughout the year as opposed to just doing it once a year?
Not really, but when the advisor is tax sensitive, usually they're not tax sensitive. They're driven by returns.
Mhm.
But we'll get calls in the beginning of the year and say, hey, I got a stock that I want to take a loss. First thing I ask them is, are there gains to offset that loss? You don't want to just take the loss if you don't need to take the loss. So it can happen throughout the year. We get calls in February and March, no doubt about it. But more at the end of the year, they look at the portfolio and say, I got 75,000 in gains. I'm going to take some losses, and we're like, definitely take at least up to $75,000. That's the way we try to monitor that.
Yeah, our platforms allow us to do this on a continuous basis, and we get outside support for that. So it's helpful. And I
Yes.
mean, this year, not so much, right? Because the market's been up. But in years when we have a more volatile market, we try to look at it throughout the year.
Yes.
Okay, how about let's move on to health savings accounts and then finally with charitable donations.
All right. Well, health savings accounts they're pretty popular these days because most plans that people have a very high deductible to meet. So with an HSA, some employers will put the money away for the employee, and it shows up on your W-2. If you make your own contribution with after-tax dollars, you get a deduction. And it's single 4,150 for this year, married filing joint $8,300. And what you do is you're able to use that money to pay medical bills, and you get the tax deduction on the front of your tax return as an adjustment to income. And it's become pretty popular because, like I said, a lot of people don't get over their deductible these days, and this is a way to be able to get some tax savings for medical.
Mhm.
And and if you're over 50, you get to put away an extra $1,000 for a single and for family.
Okay. Um, charitable donations used to be a bigger aspect to tax planning because a lot of people did itemize, but not so much anymore unless you're really making donations. You're right, 50,000, 100,000, $1 million, you're making donations, but still, you still see a lot of that, Rich?
Yes. So at this time of the year when people are starting to get the calls to make donations to their church, to their synagogue, and there's a lot of drives, yes, it's still big. What you got to realize is you get a large standard deduction these days. So if you're married filing joint and it's 29,200 is your standard deduction, and you don't have a mortgage, your only itemized deduction right now are taxes. So your real estate taxes and your individual income taxes, you only get to deduct $10,000 these days. So that means to get any favorable deduction, you'd have to spend another $19,000 to save anything. So what a lot of our clients are doing is, especially the older ones that are taking distributions from their IRAs, they're called QCDs. And a QCD is simply a qualified charity distribution. It comes directly from your IRA, and you're allowed to put $105,000 directly, that's the max, to any charity, and you can write a check from your IRA directly to the charity. The beauty of this is it doesn't affect your itemized deductions, but it reduces what you have to pay taxes on your RMD. Take an example. $50,000 is your RMD, and you don't need the money because Neil's done so well with your other investments. All right. You send $50,000 directly to a charity. You pay tax on 0 of your RMD. And the benefit of that is by not having to report the RMD, you might not get into a higher tax bracket when you combine it with your other income. So QCDs have become very, very big with my clients, because we deal with a lot of high net worth people. And if they're older, again, it's very, very popular. You don't have to do it every year, but it's become very, very popular, especially with the limitations on real estate taxes and your state tax deduction. Neil, I don't know if you deal with it a lot, but at this time of the year, talking about stocks, a lot of people have donated stocks that have appreciated to avoid any capital gains, and you get the deduction at the fair market value at the date you gift that to a charity. And there's a lot of these brokerage houses now that have these donor advisor funds. They've become very, very popular. I don't know if a lot of your clients do that, Neil, but a quick example is you own Apple, you own it for $10,000. It's now worth $200,000. Not that you're going to donate it all, but if you did, your deduction is $200,000, and you don't pay capital gains on the increase. It's a good estate tool as well as a tax planning tool. And we're doing that now through the end of the year with all of our clients that want a gift.
So thanks, Rich, for bringing that up. So yes, it's becoming more and more popular in our conversations. The idea of the donor advised funds, charitable remainder trust, other aspects to work with donations. And I guess it's a sign of where you are and we are as a firm and the type of clients we're working with to help with some of these additional items that are they're planning conversations, but they're also tax conversations.
Yes.
So we could probably have a whole nother seminar just
Yeah.
on
And
charitable aspects.
the beauty of these donations is you can tell them where you want the money to go. Okay, so just because you're giving it to the brokerage house that might run the donor advised fund, you advise them where you want the money to go. So if you want to give it to your church, it goes into this donor advisor fund. They sell the stock and donate the cash to the charitable organization of your choice.
Rich, I would love to talk more about that, but let's talk about businesses for the final 7, 8 minutes or so.
Mhm.
So business comes to you, S Corp, C Corp, LLC, whatever they may be. Perhaps we could just talk about just some basic aspects of the assets, liabilities, and equity.
Okay, well, if you're a business owner, I hope you're looking at your balance sheet and your financial statements at least once a month, even without your accountant. Your controller, if it's you, you should be looking at your balance sheet, and there's really just four numbers that you need to look at, or at least I need to look at, and I could tell you if you're making money or not, even without looking at your profit and loss. Cash in the bank, did it go up or down? Accounts receivable, up or down? Accounts payable, up or down? And inventory, up or down? That is pretty much the standard four things that you could look at, or I can look at and tell you if you're making money or not. It's pretty simple. And if you're in business, you better understand how to read a balance sheet and a profit and loss statement, because it's your Bible. It tells you every day what your business, the health of your business. A balance sheet is perpetual. It never ends. It gets carried over every year. An income statement is just for that one specific time period. Your 1 year from usually January to December closes out, you start another year. So, your income statement, you should really know. Obviously, if you're using QuickBooks or whatever, you should be up to date. You should be able to print a statement every month and talk to your accountant or talk to your controller to see how you're doing. Um, if you know what a balance sheet is, assets minus liabilities is equity. Equity is the net worth of your business. That is, if you want to try to value your business, you look at the balance sheet in that's presented to you.
So do your clients, will most business owners, are they reaching out to you on a quarterly basis, or will you just hear from people once a year?
Nope, it varies. Our bigger clients have their own controller who prepares monthly financial statements, and they handle it themselves. They're a little more sophisticated. It could be a guy that owns 50 buildings. He wants to see what's happening every month. They're big enough where they're not relying on the outside accountant to prepare them. When it comes to the restaurant industry, we do a ton of restaurants. We look at them, we go to them on a monthly basis, and we sit down with them and see how they're doing because restaurants try to run weekly, which run into a monthly profit and loss and balance sheet. So every industry is different. We have a couple in-house people at my firm that actually do the input for the QuickBooks. So we know it's right. And at the end of the month, we send them a profit and loss and a balance sheet and discuss it with them. And then we know they're listening. So
Mhm.
it varies, Neil. We have
Yeah.
hotel chains. We have a meeting with them every quarter. I go down there, we go over all the hotels, and we compare it to last year. You should always look at last year. You should always see how you're doing relevant to last year. And then if you're off, why are you off? Is it cost of goods sold? Is it sales? Is it payroll? There's just different things to look at. Every business is different. Every business is fluid.
So, for our firm, Secure Planning Group, we tend to work with business owners in some of their benefits, their 401ks, their profit sharing, their group benefits, their health insurance. We have some corporate 529 plans out there and voluntary benefits. So we don't come to the business owners with respect to talking about their books and records, but it is part of our conversation. If a company is doing well enough, then the plans and the benefits become larger and larger. So how about in your experience, do you work with a lot of advisors in conjunction with the business owners?
We do. We're the quarterback. That's the way we try to look at it. And, on our team are the financial advisors, the attorneys, the corporate attorneys, as well as the principals of the business. They have estate planning to do, to pass on the wealth of the business to their kids. So we're involved with everything. We get calls from the client, we get calls from the advisor, we get calls from the attorney. We are pretty much involved with everything. If it's not a business or if it's just an individual, because if it's an individual that you probably deal with more, Neil, than businesses, right? You deal with their 401ks. We do financial statements for the individuals as well. They want to know, what's my net worth? Okay. So by doing that, we need to talk to the advisor. We need to see what their fair market value of their accounts are. What are their liabilities? Is it worth getting rid of to paying down debt at a high rate right now when they're in a CD at 5% and they've got debt at 9%? It's an opportunity cost. So, we get calls every day, 24/7. What do I do? And that's when I call you, Neil.
Okay. Rich, I want to thank you for allowing us to ask you some questions, and to our clients who've attended this meeting. Hopefully this has been helpful to you. We are, as a firm, we're a growing firm. We have more advisors joining us, and our staff is getting larger. And we have our professional relationships that we work with. And the whole point is to try to make our financial plans with our clients the best as possible. So, Rich, again, thank you very much for having and allowing us to interview you today. And we look forward to the future together.
Thank you, Neil, for having me.
Okay, thank you.